Imagine you're sitting at your kitchen table one evening, staring at your pay stub, and you notice something. Every single month, money disappears from your paycheck before you even touch it, goes straight into this account your employer set up for you, an account they told you was the smartest thing you could do for your future, an account they practically celebrated you for contributing to, and you believe them, because why wouldn't you? They're your employer. They gave you the job. They set up the benefits, they handed you the paperwork on day one and said, this is how you build your future. So you signed up, you contributed, you watched the number grow, and every year you felt just a little more secure, a little more responsible, a little more ahead of the people who weren't saving at all. But what if I told you that while your number was growing, someone else's number was growing faster? What if the account that was sold to you as your safety net was actually someone else's income stream? And what if the rules of this account, the ones nobody explained to you, were quietly, legally working against you the entire time? This isn't a conspiracy theory. This is math. And by the end of this video, you're going to see it clearly. I'm going to show you who really created the 401k and why. The 3 ways it's silently costing you more than you realize. What the people who actually understand money do differently, and the exact steps you can take to start fixing this starting today. Don't go anywhere, because the part that's going to surprise you most comes in the middle of this video, and I don't want you to miss it. First, let me tell you about Marcus. Marcus is 34 years old. He works in logistics for a mid-sized company in Atlanta. He's not rich, but he's responsible. He pays his bills on time. He drives a used car. He packs his lunch most days, and for the past 9 years, he has contributed 6% of every paycheck into his company 401k, because that's exactly what his HR manager told him to do to get the full employer match. Marcus feels good about this. When he logs in and sees his balance, $87,000 T, he feels like he's doing better than most people his age. And honestly, he probably is. Most Americans his age have almost nothing saved for retirement. But here's what Marcus doesn't know. He doesn't know how much of that $87,000 has already been quietly eaten by fees he never agreed to. He doesn't know that the tax break he thinks he's getting might actually cost him more later than he's saving now. And he doesn't know that the fund his money is sitting in, the one selected automatically for him on day one, is one of the most expensive options in his entire plan. Marcus isn't doing anything wrong. Marcus is doing exactly what he was told, and that's precisely the problem. To understand why the 401k works the way it does, you have to understand where it came from, because this isn't a story that starts with someone trying to help workers retire comfortably. It starts somewhere very different. It's 1978. Congress is putting together a new tax bill. Deep inside the legislation, buried in the kind of language that nobody reads unless they're being paid to, there's a small clause, Section 401, subsection K. It was written for one specific purpose: to allow corporate executives to defer a portion of their bonuses and avoid paying taxes on them right away. That's it. That was the whole thing. It wasn't designed for teachers. It wasn't designed for warehouse workers or bus drivers or anyone earning a regular salary. It was a tax strategy for people who were already wealthy and wanted to protect more of what they were making. Then in 1980, a benefits consultant named Ted Benna was reviewing this clause for a client, and he had a realization. He noticed that with a slight reinterpretation, this same rule could technically be applied to everyday employees, not just executives. He pitched the idea. Companies listened because they saw something in it that was immediately useful to them. Before the 401k, companies were largely responsible for funding their employees' retirement through pension plans. A pension meant the company promised you a fixed monthly payment for the rest of your life after you retired. The company carried the risk. If the market performed badly, that was the company's problem. The employee was guaranteed their income regardless. The 401k changed that entirely. Suddenly, instead of the company carrying the risk, the employee carried it. The company's liability disappeared, and instead of funding a guaranteed pension, companies could now say, "We'll match part of what you contribute." They shifted from owing you a retirement to helping you save for your own. And American workers accepted this deal without fully understanding what they were giving up. Now here's where it starts to get uncomfortable, and I want you to stay with me because this is the part that changes how you see the whole picture. When the 401k replaced the pension for most American workers, 3 groups immediately benefited. The companies, because they eliminated their pension obligations; the government, because the structure created an enormous captive pool of money that would eventually be taxed; and the financial industry, because suddenly tens of millions of workers needed someone to manage their money. Think about what that looks like from the outside. Almost overnight, the financial industry had access to a pool of money that would only grow. Money that came in automatically every pay period, rain or shine, regardless of market conditions. Money that workers couldn't easily pull out without penalties. A guaranteed, recurring, captive revenue stream from millions of people who had no choice but to participate if they wanted to save for retirement. You know what that kind of business model is called in the startup world? Subscription revenue. Recurring, predictable, almost impossible to cancel. And the fee they charge on that subscription. Let's talk about that, because this is the part that most people, even financially educated people, genuinely don't understand until they see the numbers. Every 401k charges fees. That's just a fact. Someone has to administer the plan, manage the funds, keep the records, and those costs get passed on to you in the form of what's called an expense ratio, a small percentage charged annually on whatever money you have in the account. Now, when your HR manager or financial advisor mentions fees, they usually say something like, it's just 1%. And your brain hears that and thinks, 1%, that's basically nothing. 1% of my coffee is like 2 cents. Who cares about 1%? But here's the thing about percentages inside investment accounts. They don't work the way your brain thinks they do, because the fee isn't just charged on what you put in. It's charged every year on the growing total. And over decades, the compounding effect of that fee is catastrophic. Let me show you with a real example. Two people, same age, same income. Both start investing $400 a month at age 30. Both earn an average 7% annual return over 35 years. The only difference is their fees. Person A is in a low-cost index fund. Her total expense ratio is 0.1% per year. Person B is in a typical actively managed 401k fund. His total expense ratio is 1.1% per year. At age 65, person A has $631,000. Person B has $489,000. The same contributions, the same market returns, the same 35 years, but that 1 percentage point difference cost person B $142,000. Not because he did anything wrong, not because he made bad decisions, simply because of a number he never looked at, buried in a document he never read. Now, here's the part that should make you set this video down for a second and actually breathe. The median American worker contributes to a 401k for 30 to 40 years. Across that entire period, the average person pays somewhere between $150,000 and $200,000 in total fees. Fees they never see as a line item. Fees that are never shown to them as dollars, only ever as a percentage small enough to feel harmless. And the fund managers on the other side of that transaction, they collect those fees whether the market goes up or down, whether you retire comfortably or run out of money at 73. They get paid regardless. In 2022, the stock market had one of its worst years in recent history. The average 401k lost $34,000 in value. Real people watching their retirement savings shrink. And simultaneously, the fund management industry collected its fees, same as always, because the fee isn't tied to your outcome. It's tied to the size of your account. You carry the risk. They carry the check. But wait, I can hear you forming the objection right now, and I want to address it directly because it's the first thing everyone says. What about the employer match? My company gives me free money. Isn't that worth it? Yes, the match is real. And I'm going to be completely honest with you. Capturing your full employer match is one of the best financial moves you can make. If your employer matches 3% and you contribute 3%, that is a 100% immediate return on that portion of your contribution. No investment on earth reliably gives you that in year one. So yes, contribute enough to get the full match. Absolutely. But here's what happens next, and this is the part nobody explains during onboarding. When your employer contributes to your 401k, every dollar they put in is tax deductible for them as a business expense. The contribution reduces their taxable corporate income. So the free money they're so generously offering you, they're writing it off on their taxes anyway. You are, in a very structured and legal way, part of their tax optimization strategy. That doesn't make the match bad. It just means that the relationship is a little more mutual than the presentation suggests. They're not doing you a favor out of generosity. It's a transaction that benefits both sides, and now you know what their side of the benefit is. Now, I want to introduce you to something that I think is quietly one of the most profitable financial products ever invented, and there is a very good chance that your money is sitting in one right now. It's called a target date fund. When you enrolled in your 401k, you were probably asked to choose how to invest your contributions, and if you were like most people, you stared at a list of unfamiliar fund names and percentages and felt completely overwhelmed. So you either picked the default option, or you chose the one that seemed to make the most sense. A fund with your projected retirement year in the name. The 2050 fund. The 2055 fund. Something that says, put your money here and we'll handle the rest. Target date funds are designed to feel like a solution to your confusion. They automatically shift your investments from aggressive to conservative as you approach retirement. They're presented as sophisticated, professional, managed products that remove the burden of decision-making from you. And they are, almost universally, more expensive than they need to be. These funds typically carry expense ratios that are significantly higher than simple index funds. And multiple independent studies over 20 and 30-year periods have found that basic, low-cost index funds consistently match or outperform target date funds after fees. But target date funds are the default option in most employer plans. Millions of workers are automatically enrolled in them on day one and never think about it again, which means the fund company companies collect higher fees year after year from people who had no idea there was a cheaper alternative sitting right next to it in the same plan. This is not illegal. This is not even hidden, technically. It's disclosed in the fine print, in the plan documents, in the numbers that most people never look at. The system isn't breaking any rules. The system is just counting on the fact that most people won't look. Okay, here's the part I promised you at the beginning, the important part, the part that changes the whole picture. All of the stuff I just described, the fees, the defaults, the lock-in, the fund structure, that's the environment the 401k creates. But there's also something happening at the tax level that most people think they understand, but don't. And getting this wrong can cost you more than all the fees combined. The core selling point of the traditional 401k is this: contribute money today, skip paying taxes on it now, and pay taxes when you withdraw in retirement, when you'll presumably be in a lower tax bracket and owe less. This logic sounds airtight, and for a specific type of person in specific circumstances, it actually holds up. But let's examine the assumption underneath it. You're 35. You put $15,000 into your 401k this year. At 22% marginal tax rate, you avoid paying $3,300 in taxes today. That feels like a win. That $15,000 grows at 7% per year for 30 years. It becomes $114,000. In retirement, you withdraw that $114,000. You don't pay taxes on just the $99,000 in gains. You pay taxes on all $114,000. The original contribution and every dollar of growth all at once as ordinary income. If you're in the 22% bracket in retirement, you owe roughly $25,000 in taxes on that withdrawal. You saved $3,300 in taxes when you contributed. You paid $25,000 in taxes when you withdrew. For this trade to actually benefit you, you need your retirement tax rate to be significantly lower than your working tax rate. And here's why that's harder to guarantee than it sounds. When you retire, you likely have Social Security income, which is partially taxable. If you have any pension, that's taxable. Required minimum distributions, the mandatory withdrawals the government forces you to take starting at age 73, are taxable. And if your 401k has grown substantially, those forced withdrawals alone can push you into a higher bracket than you expected. On top of all that, nobody knows what tax rates will look like 30 years from now. Tax rates have changed dramatically throughout history. They have been as high as 90% at points in American history. They've come down significantly. They will change again. Anyone telling you with confidence what your tax bracket will be at 72 is guessing. The traditional 401k asks you to make a decades-long bet that tax rates will be lower when you're old. That's a bet that might pay off, Wayne, or might not. And unlike most bets you make in life, you won't find out if you lost until it's too late to change anything. So here's the question that naturally follows all of this. If the people who really understand money know all of this, and they do, what are they actually doing differently? Because wealthy people have 401ks too, some of them, but they don't use them the same way, and the difference is important. The first thing they do is treat the 401k as one instrument inside a larger orchestra, not as the whole symphony. They contribute exactly enough to capture the employer match, because mathematically that's still the right move. Then they stop. The rest of their investing happens elsewhere, in accounts and vehicles with more flexibility, more control, and different tax treatment. The second thing they do is use Roth accounts aggressively. A Roth IRA or Roth 401k is the tax mirror image of the traditional account. You pay taxes on the money now before it goes in. And then, every dollar of growth, every dollar of return, every dollar you withdraw in retirement is completely tax-free forever. If you're young and your income is lower than it will be later in life, a Roth is almost always the better move. You're locking in your current tax rate on the seed, and you never pay taxes on the harvest. The third thing wealthy people do is build wealth in assets they actually own and control. Real estate that generates rental income, business equity, brokerage accounts with no withdrawal penalties and no forced distribution age, assets they can access when they need them, leverage when opportunity appears, and transfer to the next generation. The fourth thing, and this might be the simplest and most important, they read the fine print. They look at expense ratios. They choose index funds over managed funds. They understand that a boring 0.05% expense ratio compounding over 40 years is worth more than any clever fund manager's promise. None of this requires being wealthy to start. It requires being informed, and you're getting informed right now. Let me bring it back to Marcus for a second. Marcus is 34. He has $87,000 saved. He's been contributing 6% to his company 401 401k for 9 years, and he has done genuinely well compared to most people his age. But here's what Marcus can do today that changes the next 30 years of his financial life. Tonight, he can log into his 401k account and find the expense ratios on every fund he owns. Just that. Just look at the numbers. If anything is above 0.5%, he can switch it to the lowest cost index fund his plan offers, usually something that tracks the S&P 500, often with an expense ratio below 0.1%. That one change, compounded over 30 years, could be worth $80,000 or more. This weekend, he can open a Roth IRA online. It takes about 15 minutes. He can set up an automatic monthly transfer, even $100 to start, into a simple index fund. That account grows tax-free. He can access the contributions at any time without penalty. And in retirement, everything in it is his, fully, with no tax due. Next time he gets a raise, instead of letting the extra money blend into his spending, he can direct a portion of it automatically into that Roth IRA or a brokerage account. Assets that he controls, money that isn't locked behind a government gate until he's 60. And he can ask his HR department for the summary plan description, the full fee document they're legally required to provide. Most people never ask for it. Most people don't know it exists. It takes one email or one 5-minute conversation. And what you find inside it might change how you think about every contribution you make going forward. None of this requires a financial advisor. None of it requires being an expert. It requires about 2 hours of your attention and a willingness to look at numbers most people avoid. There's something I want to leave you with. Something beyond the fees and the tax brackets and the fund names. For a long time, financial security felt like something that happened to other people. The people who were born with more, who had parents who taught them this stuff at the dinner table, who went to the right schools and got the right jobs and always seemed to know things you didn't. And if you grew up without that foundation, if nobody ever sat you down and walked you through how any of this actually works, it's easy to feel like you're permanently playing catch up. But here's what's actually true. The difference between the people who retire comfortably and the people who don't is almost never intelligence. It's almost never effort. The people who struggle financially are often the hardest working people in the room. The difference is information. Specifically, the right information at the right time before the decisions are already made. You now understand something that most Americans who have been contributing to a 401k for decades still don't understand. You know where this account came from and who it was originally built for. You know how fees work over time in a way that makes the numbers real, not abstract. You know the tax gamble underneath the whole structure, and you know what to actually do about it. That knowledge is worth more than any single contribution you've ever made to any retirement account, because it changes every contribution you make from here on out. So here's what I want you to do today. Just one thing. Log into your 401k account. Find your expense ratios. Write them down. That's it. Because awareness is always the first step. And once you see the number, once you make it real, you'll know exactly what to do next. And if someone in your life is contributing to a 401k and has never thought about any of this, share this video with them. Not to scare them, but because the best thing that can happen to someone is learning this while they still have time to act on it. The game was set up before you arrived, but knowing the rules, the real rules, changes everything.